One of the things that I think is critical in life is spending your time really thinking about the plan. Don't just rush into things. And this, thankfully, I would say I generally got right, but I observe a lot of people not getting it right. Right. So we talk about the program saying, I want to go in a learning environment. I want to be in a think tank to force myself to focus on my business, have people stress test it, poke holes and so forth. Let's get the business plan right. I see a lot of people just running into things and I'm like, well, why? Well, I don't know. I just want to do this. I'm like, yeah, but let's think, in chess, a few steps ahead, not just one move. The second thing is surround yourself with great people, talented, trustworthy people. I think that's critical. It's again, one of the aspects we look at investing in companies is looking at who we do business with. And we always have a saying at Star Mountain that you can't do good business with bad people.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. This podcast series is kindly supported by Franklin Templeton and Alvine Capital. Franklin Templeton is a global investment management firm that provides a broad range of investment solutions, including mutual funds, ETFs, alternative investments, wealth management, and technology-enabled financial services. Founded in 1947, the firm manages approximately $1.8 trillion in assets under management and serves individual and institutional investors across more than 150 countries. Alvine Capital was founded in 2005. It's European-focused private capital advisory and placement agent that provides capital raising services to investment managers from its bases in London and Stockholm. It creates bespoke capital raising programs that blend appropriate investor targeting and sophisticated marketing to deliver a fundraise aligned with institutional expectations. I'm joined today by Brett Hickey, who is founder and chief executive officer of Star Mountain Capital, a specialized private investment firm with approximately $5 billion in assets under management, focused exclusively on the US lower middle market. Since founding the firm in 2010, he has built Star Mountain into a differentiated investment platform, private credit and secondary solutions, with a focus on low market correlated returns, alpha generation, and tax advantage strategies. He's over 25 years of experience across private investing and investment banking, and prior to founding Star Mountain was with Citigroup Global Markets in New York. Welcome, Brett. Thanks for joining me today.
Thanks. A pleasure.
Well, we've known each other on the circuit for many years. I think we've bumped into each other at conferences, on panels, etc. And it would be great. I think I vaguely know about your background, but if you could talk us through your entry into finance, your background that predated that would be great.
My pleasure. Well, it wasn't as a crow flies. For those of you, I'll just throw out the born in Canada already before people say, I think that sounds like a Canadian accent. So I was born in Edmonton and then grew up in, unfortunately, further north, west of that in British Columbia, and moved to work on the oil drilling rigs for a year post high school to pay for college, which was something a little bit different, a little bit more normal for where I grew up. I was then speed skating and wanted to take a shot at going to the Olympics, was on the Canadian national training team living in Calgary, post the oil rigs, flipped my bike on the velodrome and took that passion and drive at the time, which I'd learned about finance, the industry more, and got excited. So I transferred over to McGill University to finish my degree and was fortunate enough to come work for Citigroup Barney in their financial institutions coverage group. And I figured knowing nothing about anything, financial institutions was a good way to start because you cover a little bit of everything, and ended up being a fantastic career opportunity with just an enormous amount of learning. And ultimately, this is what led to starting Star Mountain.
Just before we get to that, because there's some fascinating strands there. The oil rigs, clearly not a bit of a hardship posting. Not everyone's summer job as a teen or young adult. And speed skating. Love to hear what your kind of lifelong takeaways from both of those experiences have been.
It's a good question. As I think about my three kids that I do not believe will be going to work on the oil drilling rigs and also probably not in speed skating. The key aspects I think that I've learned is work ethic, focus, and grit. And it seems like those are critical elements of success in life, certainly as an entrepreneur, but also in business in general. And so the one common denominator between oil drilling rigs, speed skating, and Star Mountain Capital is we're not afraid to work hard. And ultimately, we try to generate alpha through labor more than trying to time markets.
I love that linkage down throughout all three. And then before we move on to Star Mountain, the core investment beliefs, would you say that through your time at Citibank and moving through the financial career and even thinking about starting Star Mountain, would you say you have any core beliefs that you still hold true?
I do. Some of it is similar to gravity. Supply and demand are hard to beat for a long period of time. And one of those is, even when you think about the oil and gas industry, there are times when prices are high. We're sitting in them a little bit today, given the conflicts in Iran and whatnot. And that created a great opportunity for me when I was graduating from high school in 1996 to go make quite a bit of money, given there was so much demand. It wasn't because I was highly skilled at anything. It's they needed labor. They needed people that could work hard. And that really is a big driver. And when you grow up in a small town that is very blue collar, energy dependent, you can literally see 1 year everybody's driving brand new pickup trucks with snowmobiles in the back of them. 2 years later, there's for sale signs everywhere. I'm, of course, exaggerating a little bit here, but it's not too far off of that. So, the other core belief I have, in addition to supply demand of anything you're investing in, is really understanding where the puck is going versus where it's come from, and to try to get in front of that. A similar formative experience was doing investment banking work with insurance and reinsurance companies. I always remember some reinsurance companies in particular would say, this is a great time for this risk. We're getting really well paid for it. We're going to lean in. And then there were other times where they said, this is not a very good time for the risk. The market's too hot. We're actually going to retrench and reduce what we're doing. And that was a really key learning for me, because there are a lot of investors and investment strategists that will really keep pushing something all the way until it breaks. And again, supply demand, it's out of shape, the risk reward's getting worse, and it's sort of, well, how long can it hold that bad for? And inevitably, what time has shown us, at least through '01 and '08 environments, is that doesn't play out well. And so I think that in insurance that's very probability driven, that helped form some of my mindset around how do we increase the probability of our desired results and decrease the probability of the results that we don't want to have. And I think that data has shown us timing the markets is difficult, and beating supply demand characteristics is just difficult. And so therefore one has to be aware of supply demand and looking for where the opportunities are.
Very interesting. It's like reminds you of technicals in stock market investing, just not being, cannot really, fundamentals may say one thing, but technicals also really matter. And let's fast forward then to starting Star Mountain. Can you talk us through your thought process in why you wanted to branch out on your own and what you've built?
It was really two factors. One was a cultural one, and I guess this does relate into the small town. So growing up in a small town of about 10,000 people in northern Canada, and having parents as school teachers, my mom unfortunately passed of cancer when I was 6. And I was very fortunate and thankful to have father as an educator, because the educational community really surrounded around to help me, in the old adage of it takes a village to raise kids. So I was fortunate to have that educational village around me. So growing up without much money and with a single parent, it was natural and normal that you work with your neighbors, you work with your community. You have some elderly people, you shovel the snow off their roofs. Somebody else has a good lawnmower, they let you borrow it. It wasn't abnormal, that was just standard. It wasn't something I ever had to think about. When I moved to Wall Street, the concept of then how people work together, often they refer to being one team, one firm, but you observe a lot of people very individualistically centered, not really working as a team. That was foreign to me. I didn't understand why people weren't more team centric and how they worked and operated. And I said, the type of culture I want to be a part of is where we drive hard together as a team, focused, aligned, clear, and transparent together. That's fun. Challenges, I think, will always exist. But I always like to say I like good stress, not negative stress, dealing with silly things versus let's tackle this problem, let's tackle this opportunity, let's really get after it. So that's a cultural aspect, perhaps formed from how I grew up, and certainly a way that I like to operate that has stayed true to Star Mountain, is to really build a firm that I want to be a part of. The second aspect was the opportunity. And this gets into supply demand that I mentioned earlier. The lower middle market, where we specialize, and I think today are the largest dedicated team in the country around it, about 145 full-time people. The lower middle market has a lot of really thematic positive tailwinds. We've got aging demographics. You've got banks continuing to merge and go up market, larger asset managers having such large amounts of capital that it makes it hard to do smaller, more labor intensive transactions relative to the AUM that they need to manage and maintain having deployed. And then you have a valuation arbitrage that if you can combine two or three good similar businesses into one bigger, more professionalized one, you can sell it at a higher valuation multiple. All of those factors create really positive thematic trends, which I'll refer to as smart beta, which we've then created an alpha machine overlay to really tackle and try to find the best opportunities and work with them. And those things were all obvious. We've known of people aging for a long time. The valuation arbitrage has been systematic for a long time. The trends with the banks, this is where I was fortunate at Citigroup to see and learn what are asset managers doing, what are banks doing, what are insurance companies doing, and why. So, for example, asset management firms often get a much higher valuation multiple on their management fee income versus their carried interest performance income. So naturally, there's a gravitational pull to drive AUM over performance. Now, of course, performance matters as well, but scale is crucial. When you look at a bank wants to get investment banking fee revenue, wealth management fee revenue, all this ancillary revenue value. You don't get much of that from a smaller company. So banks also have a natural tendency to want to work with bigger companies. So all these things are relatively obvious and in alignment, and it creates a real supply demand imbalance on a relative basis that makes the lower middle market a compelling opportunity. Where I was wrong is I thought that people were supposed to retire way earlier than they did. The reality is a lot of great business owners hold on to their businesses into their late 60s and 70s. And what's exciting about today is, well, we're finally there now versus the theoretical age retirement to 55 or something like that, that I think that time has just really changed.
So interesting. Given you've started working with finance, a really interesting insight that you started your career analyzing financial institutions, because it's that kind of meta level of analyzing the business that we're in. Where would you say a firm like Star Mountain, with its asset base today, what do you see being the niche there and how that's evolving for kind of I suppose, whether you call yourself a boutique or a mid-market size firm yourself? How do you see the landscape as evolving?
Our view is that there are businesses that add real value and should exist. And in our simplistic view, there's what I'll call efficient market beta. So think of a very large asset management firm, perhaps a Fidelity, pick a name, something of that nature. And that serves great value for a lot of investors. Then our view is there are specialists that really can dominate an opportunity where there are barriers to entry. You can develop competitive advantages and really bring an edge to generate alpha for investors. The last overlay is, can you develop product and strategies that can have diversification benefits to an investor's portfolio? And then if for taxable investors, can there be tax advantages as well that doesn't change the risk reward, but ultimately has a benefit at the tail end for a taxable investor? And that's what we think of the lower middle market. So at Star Mountain, we're really an alpha specialist in the lower middle market. So a lot of investors recently have said, well, why aren't you investing in software? We said, well, there's two reasons. One, it's how you need to invest in it. We're more of a value-based investor. It's hard for us to underwrite much higher valuations and a lot higher potential growth. That can happen. Doesn't mean it's a bad risk reward. It's a different risk reward. But then it's the last aspect, and this is part of starting your career with financial institutions group, is looking at products. And at the time, Citigroup had the largest wealth business in North America as well. So our team would look at products and structures and say, well, what does the wealth channel want and why? What do insurance companies want and why? And so I've always thought about what's the value we're bringing to investors' portfolio? And it's diversification returns. Well, they don't need us to access software. In fact, many would say most investors are probably far more concentrated in software than they might realize between their public equity, their fixed income, and so forth, just given how large that market space has come. And now the lending into that market, which is something we didn't see in '01. And so those are the reasons that I always think about our businesses starting with the end in mind and what's our value proposition, which is not just to be an investor. It's to really bring a value to a portfolio versus the world needing another investment firm.
And given the size that you focus on, how would you say some of the strains and stresses that we're seeing in the credit market today, as well as maybe we started this discussion focusing on demand supply. And I'm not sure whether the secondaries market is being affected by demand supply factors today, but maybe can you comment on the current backdrop to the strategies?
Sure. I'll break it into two pieces. One is the more direct investing strategy, and then two is secondary. So within the direct investing strategy, we have a direct lending strategy, and then we have a strategy that we call value-added lending, where we're really working with business owners, often in a first lien security, attaching warrants or participating preferred equity type of securities to that, to really be a partner and help them grow their business to the next level, be economically aligned to do that, be economically aligned to focus on asset returns more than asset scaling. And with our own capital, that's of course what our primary focus is. So within that segment, some of the concerns in the market have been relating to software, again, which we don't do. Some of it relates to real estate, which we also don't do. And I can get into why if you want in both of those, but there are things that we've self-selected not to do for data-driven reasons around investing, but also for being a portfolio diversifier for an investor, which we think is always critical, again, with that end in mind of what value are we bringing. Within covenant light has been a concern. This is where supply demand matters. In the large end of the market, there's been a major influx of capital from insurance, from wealth, and other institutional investors, which I don't see slowing until such time as we may eventually have a real market downturn and recession. I think that's the only thing that will really slow capital back to cause a meaningful change, would be my guess, especially with the amount of permanent capital that is embedded within that market segment. And that's where covenants have come down. So we're fortunate in the lower middle market that the resource intensity to originate, underwrite, and manage keeps a lot of the supply of capital out. That allows us to have better covenants. And then our business models to be more of a selective investor, again, more focused on alpha than just market beta. And so we take a more selective approach. So we're fortunate to not have covenant light deals that have now shown to be creating problems. I'll segue that then into your question on secondaries. So on secondaries, it's going to be an interesting one. So on one hand, let's talk supply demand again. Huge market. You've got a couple trillion roughly of assets, thousands of different managers, tens of thousands of deals, hundreds of thousands of different LPs. So big, complex, lots of different fund structures, evergreen, drawdown, with leverage, without leverage, SBIC leverage, rated leverage from insurance companies, bank leverage, right? So the complexities within credit are dramatic, especially relative to traditional private equity secondaries. All of that complexity creates both risk and reward. I think that there will be some people inevitably that will look at things and say, this sounds good. It sounds like a good deal. I'm going to take it. I'm going to buy it. And there may be more challenges than they realize. There are other investors then that have the ability to really evaluate a manager, evaluate a fund structure, get enough insights and perspective on the assets to really make some good investments. But I think either way, the market is here to stay. It's a large market. And I think there are a lot of opportunities. One of the aspects we find interesting is, again, aging demographics in the lower middle market creates motivated sellers. I always love being an investor when you have a motivated seller. And you also can have information advantages. Many times sellers just look at their net asset value statement, and as I'm sure you've found across your career, some of these assets are far overvalued and some of them are undervalued. And so you really have to be able to assess the value. But I think we will see a lot of opportunity growing within secondaries that we've been doing now at Star Mountain for about 14 years. I think probably one of the longest track records in private credit secondaries out there.
And let's pivot then to your leadership style, because there's some quite distinctive, if you look at your LinkedIn presence, your attitude to equity ownership within Star Mountain is quite distinctive, I think, given your firm's size. How would you define your leadership style and maybe your founder's style?
It's a great question. We created a value system that we call our STAR values. S is as a shareholder, and everybody likes to talk about act like a shareholder, be a shareholder. And I would say, well, that's nice for a shareholder to tell other people to act like a shareholder, but if you're not a shareholder, that's tough. So if we listen to folks like the late Charlie Munger and Warren Buffett, and they'll say, show me how somebody is motivated and I'll tell you how they'll behave type of thing. There's a lot of good data on human behavior, which I find fun and fascinating. I love human behavior and psychology. It's fun, it's fascinating, it's ever evolving. And so I said, I want to do what's selfishly in my best interest and give equity to everybody. And a lot of people then kind of scratch their head and say, I don't quite follow that. I said, well, we want people at Star Mountain waking up every day, driving hard for investment results, not just when your manager is watching. And during COVID, this was a really interesting stress test where I was very thankful for our team, the focus, the passion, because it was their economics directly impacted, irrespective of somebody not being able to see what they're doing. And so in Star Mountain, our star at the top of the mountain in our logo is our shareholders. And it's very clear, it's very transparent. That's who we work for. When I started the business and our first fund that I launched with my partner, Dave DiPaolo, 22 years ago, I had to have nearly 100% of my capital at risk. It wasn't much, but it was everything I had. Now I choose to have still the vast majority of my personal capital, over 90% of it, invested across what we do, and really building that engine. So I want a team of people that is worried about investments and trying to drive hard to maximize those investments alongside me as being as aligned as possible. And that's that ownership mentality that I think is very special at Star Mountain. And that's our S as a shareholder. T is building trust, A is accountability, R is respect. And these are just our unwavering values that we focus on. So if that helps, that's part of my leadership strategy is culture. With that, we expect clear focus, results, workflows, very data driven, not a big fan of winging it, not a big fan of, well, I've done this before. Great. Show us a clear mapped out plan then so we can stress test, so we can debate and really have iterative debate around information.
And moving now to some personal reflections. So quite an extraordinary journey that you've catalogued there. Would you say there are any highs and lows in there? And what were they? And what did you take away from some of the low points?
This is an interesting one. I get asked a question that says, would you want your children, or a way I often look at it is, we'll get students that'll come whenever I'm speaking to folks at different business schools and whatnot, and they say, hey, are you happy you started it? Would you do it again? Surprising to many people, I often say, I don't think I would for my children. So would I again? Yes, I would take the risk. When I was young, risk implies something to lose. When you're 26 years old and you have nothing to lose, you can afford to take risk. I could work 7 days a week. When somebody said you need to do X, Y, or Z, the answer is all in. And I chose to have kids later in life, get married later in life, to be very, very focused on building what I hoped would be a strong foundation, knowing that the probability of success was probably quite low. In fact, I remember running into a friend of mine that I talked to when I was leaving investment banking and said, I'm looking to start this business. I'm probably going to fail. What do you think that's going to do for my career if I'm knocking on your door saying, will you hire me as an associate in private equity or something? He said, you'll probably learn more failing than you will spending more time in investment banking. And that was really a key thing for me, is to drive that. But to your point of lows, it's difficult. I mean, I remember months where back in the day when we had a lot more coins, income from Canada, your toonies and loonies and stuff like that. I remember having this bag of coins. I'm like, I wonder how much money is in this bag now of just random change, because I actually need this to eat. And thankfully, there was about $800 in it. But my personal rent, I was a couple months due on. My office rent, I was late on. It was scary. Thankfully, you've no kids and so forth that way. And, but these are very scary, very challenging things. And I think most business owners and entrepreneurs talk about a lot of different inflection points that were very difficult. Every once in a while, I talk to somebody that everything just was a hockey stick up and to the right, but I think that's more rare than normal. And it's hard to really celebrate the wins. I often talk to my wife that being a CEO sometimes is the global head of complaints is another title for it. But ultimately, there are a lot of things that are very satisfying. And I think that to be a great CEO, you've really got to be good at handling stress. So for me, this gets into your cultural question a little bit. I put a high premium on eat well, sleep well, exercise, so you can have the mental focus and clarity, perform under stress, because you will be under stress all the time. There's always going to be lots of challenges. And in fact, I'll end with this psychometric profiling, talking to a lot of different people that are really experts in talent fields. And I said, well, what are some of the things you've learned? And they say, for great CEOs at the end of the day, your ability to think strategically and manage stress, if you can get those factors right, that's crucial. And so it's a big part of our underwriting at Star Mountain is really working with evaluating people. And it's one of the things that I love about the lower middle market is helping people help affect change. But I also love the transparency that we can get in evaluating teams and people, not just reading historical financial statements. And I think in this AI, I'll call it infused world, this is going to matter more than ever. Right? Whatever your historical financials, if you don't have a management team that's on the ball and ready to drive and look at threats and opportunities effectively, I think it's going to create what many talk about of this K-shaped economy of more winners, more losers, and therefore investors probably want to be careful of too much market beta if volatility increases, particularly in fixed income strategies, and particularly if they're levered strategies, which gets into, again, threats and opportunities in credit.
That's so interesting. And as you spoke about managing stress, that was another thing that made me think of AI, given we're seeing org charts being completely restructured, the middle management layer taken out, management somehow perceived as mere conduits for information, when I actually think this stress mitigation and handling and conflict resolution and strategizing part of management and leaders is something that's not very easily replaced at all. So I think a very interesting sort of is a morsel of insight there. Second, next reflection question is around people, key people throughout the trajectory of your career. And I know you've already touched on a few. This is never exhaustive, this list, but maybe any one or two that you can mention, anyone that had a particularly formative role for you?
I'm selfish as I talk about sharing economics with my entire firm. I'm also selfish in trying to collect talent, as much talent as I can possibly get aligned with me and on my side to help us. So at Star Mountain, we have a really highly valued senior advisory group that's really been incredibly impactful to me in my life, both personally and professionally, for which I'm extremely thankful of. One of the things I'll start with was a program. So I've been in the Young Presidents Organization now for about 18 years. That organization with other CEOs, being authentic with each other. Here are challenges we're facing. How are we addressing them? Not just the cocktail talk, everybody's doing great, everything's perfect. If the world was actually like that, it would be a whole different world, right? So having authentic, real talk, and I think that's been key. Taking my love of authenticity, I found a program at Harvard Business School called the Owner President Manager Program, where you apply with your business, has to have a certain size revenue, you have to have a certain ownership and a certain management position as part of your application process. And I was able to spend approximately 1 month, about 3 weeks, each year for 3 years living on campus at Harvard Business School, working with a lot of phenomenal professors working on our business. So I found this program in 2011, and having parents as teachers and grandfathers as a professor back in Alberta and whatnot, I've always loved education. I love learning. I love psychology and so forth. And so this program was great because it was all, let's work on our business. Let's build our business. What makes sense about our business? What doesn't? And I remember one of the professors that I had, Rob Kaplan, who's now back at Goldman as the vice chairman, was actually on our advisory committee when he took a full-time role back at Goldman, had to leave that. But Rob was just phenomenal. First off, cut to the chase guy. Really, let's be specific. Let's be to the point. Let's be thoughtful. And I really value and admire that. He talks a lot about alignment, focus, and so forth, and has published some good books and whatnot. So that was quite formative for me. And I felt very fortunate to build a relationship, with him over time. Another one last Harvard Business School professor, Josh Lerner, who's on our advisory committee, just thinking about the business. And Josh thinks a lot about lots of different things, but putting his economist hat on is, does a business really make sense? And Rob, similarly. And one of the things in this program that they'd ask you, and these are people that own banks in Venezuela and stuff from around the world, they say, what problem or problems is your business solving? If you can't clearly identify that, you have a problem and you should think of selling your business. Second is, how are you uniquely distinctive and differentiated from your competitors? What is your real value proposition? Star Mountain, we're not trying to be all things to all people. We're a lower middle market alpha specialist. And, I think there are a lot of firms in investing that don't really know what they are. They're kind of stuck in the middle. They're not BlackRock. They're not a, specialist Star Mountain. And I think that's likely going to be some shakeout, I would guess, over the next, 5 to 10 years. The industry is certainly going through a lot of consolidation challenges and maturation that way. And then lastly, Brian Finn was very fortunate. In fact, one of the things that inspired me to the finance industry was the Barbarians of the Gates and different things like that. Back in the day, reading as a kid, I'm like, this stuff sounds exciting and enthralling. How do I get there? And how do I get to New York City? Which McGill University was a great entry point for me, and very thankful for the education where I did my undergrad there. And I know you and I have talked about that a little bit, but that was really helpful. And Brian really taught me, think about who you do business with as being a critical thing and how you act and comport yourself. And one of the guys on my team calls it the Finn doctrine, saying it's like all else equal, you should be polite and respectful to people. And that's getting Star Mountain's values, like ours, respect. And I'm sure you've come across many people in your career, right, that are know-it-alls and all these different things and very abrasive. And I've just found really successful, great people that are responsive, that are transparent. They don't always give you a yes, right? You don't always get the answer you want, but they're polite and kind and so forth. And I just think that resonates with me. And I think that's a better way to live, a better way to teach our kids how to live. And I think it's better business long-term. So those are some things that were formative. I'll give as 3 examples.
Fantastic, rich, I think, enveloping values, not just on the finance side. So thank you for that. And my last question is around any creed or motto. I know you've spoken about a lot of business creeds and mottos, but maybe on a personal level, or any advice for that young student coming off the oil rig, or just hanging up your speed skates to take on something new. Anything now you wish you had known then?
Lots of things, unfortunately, that I wish I knew then. Would have been maybe a more direct versus S-shaped curve. One of the things that I think is critical in life is spending your time really thinking about the plan. Don't just rush into things. And this, thankfully, I would say I generally got right, but I observe a lot of people not getting it right? So talk about the program, saying, I want to go in a learning environment. I want to be in a think tank to force myself to focus on my business, have people stress test it, poke holes and so forth. Let's get the business plan right. I see a lot of people just running into things. And I'm like, well, why? Well, I don't know. I just want to do this. I'm like, yeah, but let's think, in chess, a few steps ahead, not just one move. The second thing is surround yourself with great people. Talented, trustworthy people. I think that's critical. It's, again, one of the aspects we look at investing in companies is looking at who we do business with. And we always have a saying at Star Mountain that you can't do good business with bad people. And I think part of that we also have to recognize with aging demographics and with different aspects, and COVID was a learning where people got sick. This is where mental health and wellness are also really important. And I think we all need to do our diligence in general around that, because we're investing in the future with our careers, not in the past. So when you look at a firm, focus on the future, focus on your alignment with them. And can you see yourself driving hard with these people? Because I think the default is you will face challenges. So you want people that you're going to face them in the trenches together, not pointing fingers, but solutions oriented, working hard, being focused. And I think repeating that over time is what creates a lot of value. I think that the fallacy I'll end with that people sometimes do, and you see this often, I'm sure you've seen it in your career a lot, where people are always kind of jumping every 2-3 years to another place. I've never seen that really amount to much. I'm sure there are the odd exceptions around that. But when you look at people that have spent 20, 30 years, I remember we do some business with firm KBW, and Tom Michaud is a friend of mine in Greenwich here. He's had one career his whole life as a CEO, running a big division of KBW Stifel. I always find stuff like that extremely endearing. Building trust, building leadership, building capabilities. And look, if it's not a good business or good people type of thing, then there's obviously good reasons that you should consider changing your career. But if you find really great people with a great mission, a great passion, and a business plan that makes sense, recognize it'll take some time and have a team that wants to put effort into it with you. Those are the most successful, and I would say fulfilled people. It's not just financial successes, as you well know in life. It's about totality of success, including being with trusted, fun, great people.
Well, that's wonderful. Well, I think one of the other fallacies that we often think about is that there's a choice that needs to be made between running a strong business and values, that these are things that we cannot always have intersect all the time. I think we've particularly seen that, as you mentioned, COVID, in the post-COVID era, when we've seen, I suppose, this disintegration of some of the value system, perhaps, and a focus on profit and return. And what I'm really struck by throughout this conversation is how this does not need to be an either or, that may be a false choice, that it is possible to integrate fully from inception and to continue to richly reintegrate as a business grows. So thank you so much, Brett, for filling in some of these gaps for us.
I think long-term especially. Short-term, maybe it's a little bit of short-term pain for long-term gain, but I think you're right. I think values and profits can be aligned long-term if you keep that long-term mindset.
Well, thank you for staying true to your values throughout, and on your LinkedIn follow is very worthwhile. And thank you for sharing your insights here with us.
My pleasure. Thank you.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear from more inspiring professionals and their stories, you can find us on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.